Hello, everyone. Hope you've had a great week and month thus far. I'm excited to be hosting the second episode of our new program series, Infrastructure Dimensions and Economic Development on Amorgate Radio Communications. I remain Titilola Ogunshona. Last Friday at the maiden episode, we considered the main types of infrastructure, which includes the hard and soft infrastructure. We went further to consider other dimensions or forms of infrastructure crucial for attaining economic growth and development in any nation or country. One of the forms of infrastructure that we mentioned last week was financial infrastructure. Today, we'll be looking closely at what financial infrastructure entails. We would throw more insight on the concept of financial infrastructure, introduce key elements of financial infrastructure. We'll look at the role or relevance of financial infrastructure, and we'll be looking at empirical evidence around the globe on this concept. When we say financial infrastructure, what do we mean? It refers to the foundation of the financial system of an economy. It includes the institutions, information, technologies, the rules and standards which enable financial activities, and these could also include financial intermediation. Typically, when we talk about financial intermediation in finance, you are looking at an institution or a system that stands as a connection between the deficit sector and the surplus sector. That is, you have people in an economy or in a nation that have the funds, they have the money, and we have at the other side, that's the surplus sector, other side, the deficit sector, those individuals, firms, businesses, government agencies that need capital, that need funds to invest in productive activities. And this productive activity is expected to lead to an increase in economic growth, that is, increase in productive capabilities of a country, both in terms of an increase in goods produced and increase in services rendered. So when you talk about financial intermediation, it's a very crucial role because it serves as that bridge between the deficit sector and the surplus sector. Furthermore, financial infrastructure entails underlying foundations of a nation's financial system, which will also include an adequate legal framework, efficient enforcement mechanisms, and availability of credit information and well-developed payment systems. You're looking at how all of these factors that I've mentioned will contribute to the stability, the depth, the efficiency, and access in the financial system of any nation or country or economy. Every country would have its financial system that will come with its peculiarities, but whatever it is, whatever financial system that you have in a financial system, the core of it is the financial infrastructure because it's going to determine the efficiency of its functioning. Why? Why is it so? Because it includes, like I mentioned earlier, the technical system through which payments are made in the economy. It includes transactions with financial instruments, how they handled, because efficient running of this financial infrastructure will ensure that payments are made and received safely and efficiently by individuals, firms, companies, corporations, government agencies in a country. And an efficient financial system would ensure that payment for sale and purchase of shares, your debt securities, financial instruments are carried out at the least cost. Okay, because if you have a financial system that is not efficient, and that will be dependent on the strength and efficiency of your financial infrastructure, the cost of purchase of securities, shares, debt security, financial instrument, we come at a very high cost. And that is going to impact the efficiency of the financial market in terms of performance, because investors would be discouraged if the transaction cost is very high. And the reality is that banks and other financial institutions are participants in financial infrastructure systems, and these systems also participate in each other's system. Thus, we can establish that there is interconnection among this system, which reveals that there are quite a number of interdependencies between the systems in the financial market infrastructure, particularly the banks and the financial market. As we go further, we'll talk more about the financial system, the financial market, the types of financial market you would have, look at the peculiarities of financial markets across the globe. So, because these systems are interconnected, it implies that any defect or problem that is inherent in the financial infrastructure of a nation would have a negative effect on the financial system of a nation. So it means that the success, the efficiency of a financial system would depend on the level of development and efficiency level of your financial infrastructure. It becomes imperative for government to ensure the efficient functioning of the financial infrastructure in order to achieve or maintain stability and growth of the financial system. And definitely this would have multiplier effect on the economy in terms of economic growth, and if well sustained across other sectors, will lead to economic development. So why do nations need to ensure that the level of financial infrastructure in their country is well developed and operating at efficient levels? Okay, I like the remark by David Dodge, and is of the opinion, which I agree with, that the global financial services sector continues to undergo changes, which include the continuous integration of global financial markets. We have experienced consolidation of exchange and financial institutions. You see, all of these changes have impacted the manner, the mode, the way that global markets operate. And this has far-reaching implications in terms of competitiveness and efficiency of a nation's market and institutions, particularly financial institutions. Now, what we had, the traditional way of banking about 2 decades ago is not what we have right now. About 2 decades ago, how many financial tech companies did we have? About 2 decades ago, you have to go to the traditional banks to open your account. You have the account opening packages that you have to fill. Even about 4 decades ago, we did not even have universal banking. That means if I open my account with a particular bank, let's say Zenith Bank in a particular branch, maybe at VI, at Victoria Island, Lagos, I'm not likely to be able to withdraw from another state. That was about 3-4 decades ago. It evolved such that you can, what is the bank anywhere in the world, you can withdraw. So things have really changed. So that's why you cannot afford to be static, in terms of your level of development of financial infrastructure in a nation, because it's going to affect payment, it's going to affect the way transactions are handled. It has far-reaching implications if you are not deliberate as a nation to continue to evolve, to continue to innovate, to continue to, be creative, innovative with your processes that would reduce transaction costs, that would reduce the turnover time in handling transactions in the nation. So what are some of the benefits, of having well-developed financial infrastructure? One of the benefits is that it's going to increase the efficiency of the banking sector. We talk about financial infrastructure, talking about the way payments are handled, talking about even credit bureau, will go into that, but it's going to increase the efficiency of the banking sector, because if people can make payments easily, if people have access to forex easily, it means that it's going to encourage international trade. It's going to encourage seamless, transaction, and that would impact, the performance of the banking sector. And you can actually see that in terms of even the financial performance of the banks. You see definitely a rise in transaction activities, a rise in fees collected, which is going to impact the profit margin, lead to an increase in profitability level, and that would even allow the bank to expand. So it's going to increase the efficiency of the banking sector in a nation if you have well-developed financial infrastructure. And another thing we would do if you have well-developed financial infrastructure is going to facilitate financial activities, because it's going to create the platform for individuals, businesses, government officials to pay and receive payments. So it's going to encourage more people, more businesses channeling that funds through the banking sector. Okay, and also when we talk about the financial market, we talk about financial instruments. As mentioned earlier, we have the stocks, we have the debentures, and now it depends on the kind of financial market you're saying. Are they going to be short-term instruments, medium-term instruments, long-term instruments? Because when you talk about the financial market, we have the capital market, we have the money market, and the money market is the market where short-term financial instruments are bought or sold. Okay, so it depends, and it's going to, when now talk about the shares, you talk about the capital market. So when you have well-developed financial infrastructure, is going to facilitate financial activities, and that also includes the sale and purchase of financial instruments. More people would want to, especially for the money market instrument, and that will allow the commercial papers, it will allow the firms to raise money for their short-term needs. Because if you don't have well-functioning financial infrastructure, if it's inefficient, a lot of people will not want to, invest, in terms of purchase of commercial papers, short-term funds, and that is going to reduce, the accessibility of funds by businesses that will need that to produce more or offer more services. And if that is reduced, and if firms can have access to funds, definitely it's going to impact the level of economic growth, and in the long run, level of economic development in the nation. So you can't talk about economic growth, you can't talk about economic development if your financial infrastructure is not well developed as a nation. The example I cited of universal banking, I'm referring to developing countries with particular focus on Nigeria. Okay, about 4 decades ago, we didn't have universal banking. You have an account with a particular bank, a particular branch, you can withdraw in another state, okay, and that's evolved to show you the extent of involvement, and when that evolves, when it gets developed, it makes payment easier. You can withdraw anywhere, and we have even moved to the area of the fintech, like I mentioned. And another reason why you need to continue to develop your infrastructure in terms of financial sector, financial infrastructure, is that it will promote financial market growth, okay? Because a well-developed and functioning financial infrastructure would help investors to make better informed decisions. And if investors can make these informed decisions based on data, easy access to data, then they can invest more. And the more they invest, the more fund comes into the capital market and the money market, the more developed the financial market rate, and you are going to experience growth. And growth of the financial market, implies more fund, and that should translate to economic growth, of the country. And of course, if it's managed consistently across other sectors in terms of the gains of the financial sector, having having multiplier effect on other sectors, it's good, and we expect that it will lead to economic development. Okay, what else can develop financial infrastructure do for us? A strong financial infrastructure would ensure financial stability of a nation. And this is very crucial, because well-developed and efficient running financial system would help to prevent financial crisis. We really don't want the case of Greece to happen in your country. We've had countries that have run into financial crisis. You don't want that to happen. So there's the need to continuously develop the level of financial infrastructure in your country. And the reality is that many developing countries have poor or weak financial infrastructure. And what it does is that it limits the financial institutions' capacity to expand financial services offerings. This includes credit, savings and payment services to underserved part of the population and nation. Like in Nigeria, the time we talk about banking the unbanked. Okay, this speaks to the level of financial infrastructure development in the country, but it's way improved. Okay, even among other African countries, the level of financial infrastructure development in Nigeria is quite high. Okay, now need to know that this situation that's peculiar to developing countries poses a great risk for the financial system. How? Because poor, inefficient payment and settlement systems may induce financial crisis. Likewise, absence of credit bureau and strong credit growth could also lead to financial crisis. And there are key financial infrastructure elements that are crucial in ensuring greater access to finance, improving transparency and governance, safeguarding financial stability of a nation. They include well-developed functioning credit bureau, enforcement of collateral and functioning payment, security settlement, remittance systems. Okay. Now, another thing that is quite unfortunate again is that for developing an emerging market, they either do not have this key element or they have this key element that I've mentioned: the credit bureau, enforcement of collateral and functioning payment, security settlement, remittance system. They could have it, but these systems are largely underdeveloped in the economy. If you're just joining us, thank you so much for joining. Today we are discussing one of the forms or dimensions of infrastructure, that is financial infrastructure, looking at the role it plays in attainment of economic growth and development. And what have we done so far is to look at the concept of financial infrastructure, what it entails, what does it mean, looking at the role that it plays, also why nations must seek to improve the level of efficiency of their financial infrastructure. Okay, so going further, we'll look at financial infrastructure more intensely. Okay, financial infrastructure, as we've said and you can see, is an important part of the financial system of a nation. In other words, the quality and efficiency of financial infrastructure would have far-reaching implications. How? Okay, let me talk about the how. It will determine the efficiency of intermediation. I've explained what intermediation means, especially in the context of financial intermediation earlier. It will also determine the abilities of lenders to evaluate the risk when you want to give out money as loans, okay, in forms of loans. You want to evaluate the risk involved, okay. So, and also the ability of borrowers to obtain credit in terms of loans, insurance, and other financial products at competitive rates, terms, or conditions, okay. And the reality is that the process of strengthening the financial infrastructure of a nation isn't automatic. Okay, that's reality. It's not going to observe. We've spoken about the fact that what is peculiar to, developing countries, or what we call the emerging countries, is that some of these key crucial elements are either not in existence, or they have them but they're largely underdeveloped. So strengthening the financial infrastructure process is not going to be automatic. It's going to take time, yes, to achieve that. It's going to take resources to achieve that. And particularly, one thing that's going to take from the government is the political will to achieve this. And the motive of all of this is to, have infrastructure that is well developed, that can lead to economic growth and help nations to achieve economic development and even sustainable economic development. To achieve economic development, it's important that the productive sector, you talk about the manufacturing firms, the real estate, you talk about the fast-moving consumer goods sector, the FMCG, among others, they must have access to finance. The ability to access finance would largely be dependent on a nation's level of financial infrastructure and also the existence of a sound legal and regulatory framework. You must ensure that everyone in need, that we're talking about everyone, every business, every organization, every firm in need of finance, particularly for investment purposes, down to the last person in the pyramid, would have access to finance, and this will be dependent on the existence of well-developed and functioning financial infrastructure elements. As earlier mentioned, we mentioned some elements that will determine the access to financial credit. It's important. Now, we mentioned credit bureau, we're mentioning now the payment and security settlement systems, we're talking about collateral registers, and most importantly, creation of an enabling legal and regulatory framework that would enhance efficient running of all the above elements that I've mentioned: the credit bureau, the payment and securities, the settlement system, the collateral registers, remittance system. You want a legal and enabling legal and regulatory framework that would ensure that these elements can function optimally. Also, you also want to ensure that government is deliberate about partnering with financial institutions, talking about the commercial banks, the retail banks, the microfinance bank, the mortgage bank, leasing companies, helping them develop optimal institutional capabilities. You need to now with them to function optimally. And like I mentioned earlier, it has changed, Even right now, we have innovations in fintech. We talk about the brandless banking, mobile banking. It has redefined the landscape of the financial systems and markets. And these they have their demerits and their merits, While we have experience increased access points with more available and affordable products and services from the financial sector. Of course, there are risks inherent in the development of new products and services, particularly the delivery channels. So we want to create a system. We want to have structures in place that can proactively identify these risks, and also we have regulatory frameworks in place that are well developed to mitigate the negative effects of identified risk, because this will actually speak to the functioning of our financial market, will speak to the financial stability of a market, and it also speaks to the level of economic growth in such countries. I mentioned earlier that the ability of firms, individuals, corporations, government agencies to access finance would largely be dependent on the nation's level of financial infrastructure, in addition to existence of a sound legal and regulatory framework. So we'll be looking at countries that offer easier access to capital. At the introductory stage of this episode, I mentioned that we'll be taking empirical evidences across the globe. And this particular one we're going to be looking at is a survey of that was carried out by Global Survey Respondents, and it was carried out on about 89 countries, and we'll be considering the top 10, looking at the top 10 countries that provided easy access to capital. This was carried out about 2 years ago, as of 2023. Now, one thing I want us to take note of is that for countries with high access to capital, where people have access to capital, you realize that the GDP per capita of such countries will be high, and even the GDP of such countries was very high, because the more access to finance that people have, they can employ it back into the businesses, and it will help produce more, increase the productive capabilities of those companies. Even for government, to help government carry out infrastructure development, which will provide the right investment climate for businesses to thrive. Okay, so we'll be looking at number 10. At number 10, the 10th country with easy access to capital is China. Okay, and the GDP per capita of China is about $24,558, and the GDP of China is about 17.8 trillion. Okay, and the population is slightly over 1.4 billion. That's China at number 10. Okay, at number 9 we have Singapore. Okay, Singapore has a population of about close to about 6 million. Okay, the GDP per capita is about $141,500 US dollars, and we have the GDP about 501 billion US dollars. That's Singapore at number 9. So you look at what are they getting right. It will be good to study more. We'll take it on other episodes on what have they done right, what are the lessons that developing or emerging economies can learn from them. Okay, at number 8 we have Qatar. Okay, the GDP per capita of Qatar is about 121,125 US dollars. The GDP was about $236 billion, and it's a country, from the Middle East. Okay, at number 7, what we have at number 7 is a country in North America. That's Canada. And there are interesting facts about Canada because it takes about 2/5 of North American continent, making it the second largest country in the world after Russia. The GDP per capita is about 61,582 US dollars, and the GDP is about 2.14 trillion dollars. That is also high. So you see Canada having the seventh, taking the spot at number 7 in terms of top countries that have provided easy access to capital. And number 6 is another country from the Middle East, like we have Qatar here. Okay, is regarded as the giant of the Middle East, with both the vast majority of land and wealth of the Arabian Peninsula falling within its borders. It has a GDP per capita of 57,992 US dollars, a GDP of about $1.07 trillion. That is Saudi Arabia at number 6. So we've taken 6 to 10. Okay, so 6 Saudi Arabia, 7th, top country that provided easy access to capital. We have taken Canada, we have Qatar at number 8, Singapore at number 9, and China at number 10. So which of these countries ran between the 1st to the 5th position? We'll be taking it from number 5 now. At number 5, we have another country, from the Middle East. That's United Arab Emirates, with a GDP per capita of 83,903 US dollars, a GDP value of $504 billion. That is United Arab Emirates at number 5. We have, the interesting statistics from number 4, the 4th, 3rd, 2nd is interesting because these are countries, in Europe. Okay, at number 4 we have Germany, and Germany, from empirical evidence, has been declared the most populous nation in the European Union. So GDP per capita for Germany is about 69,338 USD. The GDP was about 4.46 trillion USD. That's a lot for Germany at number 4, and no wonder that you can see that having easy access to capital would have an effect on the nation's GDP. At number 3, United Kingdom, we have the GDP per capita at 58,906 USD. We have the gross domestic product value of $3.34 trillion USD. At number 2, okay, we have Switzerland. That's another European country. The GDP per capita of 92,980 USD. We have the GDP value of $885 billion. That is Switzerland at number 2. Okay, so which country ranked the first in terms of providing easy access to capital is no other than a country in North America, that is United States, with a GDP per capita of 81,695. Okay, and the GDP value is 27.4 trillion USD. That is United States at number 1. Now, what you have done is to look around the globe to say that, the level of financial infrastructure would determine, the access to capital, in terms of flexibility, in terms of technology that would aid, the transaction process that will be seamless. So we have countries with easiest access to capital. So running through at number 1, we have United States, 2, Switzerland, 3, United Kingdom, 4, Germany, 5, United Arab Emirates. At number 6, Saudi Arabia. 7, Canada. 8, Qatar. 9, Singapore. At number 10, China. Looking at 89 countries. Okay, it would have been good to take countries ranking from 89 to like 80. It would be good to take those countries too, but we can take that on today's episode. Okay, so we've started the journey of financial infrastructure, looking at that dimension important for achieving economic growth and development. So we'll be unraveling a lot of issues, in other episodes as we go on in this new program series. On this note, we would want to draw the curtain here. I hope that you have learned one or two things when it comes to financial infrastructure. You can talk about it in terms of what it means, in terms of the key element, the role it plays. And we're also looking at one of the crucial elements, okay, that is accessibility to capital. And I know by now you should be able to say one or two things. And of course, empirical evidence across the globe, looking at countries that have gotten it right in terms of easy access to capital. And we have continent performing so well, as in Singapore and China. In Asia, we have from the Middle East, we have Saudi Arabia and Qatar. We also even have from North America, we have the United States, we have Canada, and for Europe also not doing badly, doing so well in terms of having 3 countries at number 2, 3 for position. That's Switzerland, United Kingdom, and Germany. Okay. And that's it. We talk about United Arab Emirates. That is 3 countries, from the Middle East. Okay. And thank you so much for joining us on today's episode. It was a delight to have you join us today. Thank you. We hope that you would join other programs next week. We have programs that run from Mondays to Fridays. My program, this will run again by God's grace next Friday, 5 p.m. WAT. Remember, at Amogate, for your consulting needs, communications needs, we have you covered. You want to learn more about us, the website is www.theamogate.org. And if you have questions, feedback, and there things you want us to consider on this new program series, there's a particular type of infrastructure dimension you want me to talk about, we would welcome your feedback, your questions, your suggestions. Just send a mail to us. The email is contact@theamogate.org. Till I come your way again next week. But before I go, I want to leave us with a quote from Ben Bernanke. We say the lesson of history is that you do not get a sustained economic recovery as long as the financial system is in crisis. I hope you ponder on that, as you go into the weekend. Wish you a fun-filled, rewarding weekend, and look forward to you joining us next week for our programs. Well, till then, stay blessed and enjoy your weekend.